Morning. Welcome to the Brew. Today we talk about Disney. Has the magic left the kingdom? Let's find out on the Brew opening bell. Good morning, Jason.
Lex, what's up? What happened to your bell?
I don't have a bell. I'm as you can tell, as you can see, I'm in a different place. I'm in Vegas. It looks like I'm in a witness protection program, doesn't it?
Got to turn the light on in your room, man.
Right, I know. So this is the best space I could find in my room, overlooking some of the, I don't know if it's the strip, but something out there. How are you, man?
I'm doing all right. How are you?
Good. I think it feels like the market is never going down again. I mean, honestly, it's unbelievable.
Yeah, I mean it has been insane. Like what has it been, like what, 13-14% since October?
Yeah, I think that's right. I always think I'm going to get a little bit of a pullback just naturally, and it just keeps running up the mountain every day. I'm not complaining. I mean, it's great, but
yeah, it's been pretty hardcore. I mean, there's a lot of liquidity, like positive liquidity announcements, and then yesterday with the whole pivot from Jerome Powell. I mean, it was a clear pivot. It was kind of, I was shocked. I didn't think that was going to happen so soon.
Right. So what did you take? What's your takeaway with Powell? What's the reading between the lines with Powell? Would you say?
So I don't want to try to read between the lines because that's but honestly, what I was expecting more or less was kind of the same, a little bit. We're not going to stop until the job is done, which he said, but he kind of started hinting that the job was almost done. But the reading that we got from CPI on Monday was flat. Like it didn't, it was 4% annualized and then 4% annualized. Like what? Right. So I thought he would say, and it's not even halfway. I guess it peaked at like 5.7 annualized, and he wants to get it down to 2. I figured he would recognize anyway that it was like the easy part's done. The supply chain problems that were causing inflation is mostly satisfied. Now it's hard. It's the demand part, and he needs to bring down. But he didn't mention that at all. I think he was happy. He would seem to be ready to pivot. He wants to have that soft landing touchdown. He's ready to try to really make it soft. And that's my thought anyway. But I'm reading really between the lines.
Yeah.
What changed between yesterday and 12 days ago? Nothing, except, I mean, the one thing that did was Trump overtook Biden in the polls. Maybe he doesn't want to work for Trump.
He probably wouldn't, right? So
he did, or he's got a choice.
So when you say soft landing, are you implying that interest rates might be ticking down even?
Well, so I mean, all right. So soft landing, I think when people refer to a landing, I think they're referring to growth, like a growth story.
Yeah.
GDP has still been positive, and unemployment has still been pretty low. And that's basically their dual mandate is inflation and employment. So what I'm implying then when I say soft landing is that we do not have any quarters of negative GDP or very few quarters of negative GDP.
Right.
That's what I think they mean when he says soft landing, and no major unemployment bumps, even though in the SEP they're kind of predicting a little bit of growth problems and a little bit of employment problems, but nothing that would shade your recession chart gray.
Okay.
So I think that's what they mean by soft landing.
Okay.
But is that what Jerome Powell, what he's doing then is he's implying that they are going to lower interest rates to try to get growth coming back, so that economic conditions are not restrictive at the perfect time.
Right. So how do you trade this, if at all? What's and I'll even let you toss in a Volin
Well, all of
with this
this,
one.
I mean, what we're talking about here is all macro stuff. So, when I talk with macro friends, they're trading, they're very bullish on bonds now, or, treasuries overall,
Mm-hmm.
because, if you're lowering interest rates, the value of your treasuries are going up. But if there is a recession, the value of your treasuries are going up. So, I mean,
Yeah,
I think that long bonds is a strong move, but it has to be way out in the distance. It
yeah.
has to be some time out. Um,
Okay.
so I mean, like then there's like your risk there is, um, I guess if inflation starts ticking back up, then you start
Right.
having risk. Um, you know, Equities have gone through the roof. I mean, it's
Mhm.
been kind of a historic run, especially compared to realized vol, which I guess we'll talk about soon.
Mhm.
Um, Usually these kind of things don't end very well, but or they're short
So
lived. So I mean, that's kind
yeah,
of but you would want to basically, if you want to trade that, you would probably want to buy the dip if you believe that Jerome Powell has achieved a soft landing kind of thing. And maybe we'll have a little correction like you want, and then you buy it, when you feel comfortable that the correction is
right.
over.
Okay. Yeah, I think I mean it feels a little bit 2008ish. I don't know. There's so much happiness and glory right now. I'm like, is it really this way? I can't sink my teeth into it. Yet the market will bend you into a pretzel no matter what. And I got to be honest. I've been playing from the short side. It seems logical, but it hasn't worked very well. I can say that.
Yeah, I
My
mean,
God.
basically my current positioning right now is I have very long term puts, that are leaps, and I hedge them. When basically Volland is saying, upside is possible, then I hedge using, selling the puts underneath. But with this huge rise, like I've been rolling up those
Yeah.
hedges a few times. Um, but yeah, and then I bought a straddle because implied volatility was so low compared to HV, and really I'm making money on the gamma more than the volatility.
Wait, did you say you bought a straddle? That sounds awful.
Strangle, actually, a March
It's
strangle.
even sounds it sounds even awefuller.
Well, I mean, you would think so because implied volatility went down, but now I have my call side is in the money now. Like its
Jeez.
gamma is sky high. So
Right, right. Wow, that's impressive. Yeah, even when vol's really low like that,
mhm.
I still struggle. I can buy Vega. I struggle just buying outright premium. Still,
Yeah.
I know it's probably the right thing to do. I just don't like having long premium as my sole strategy because it feels like a 10 pound or 100 pound weight on my neck in the ocean trying to tread water. I don't know.
Mhm.
It's always been that
Yeah,
way.
I mean that's why I also like selling the shorter term puts
Yeah,
against those leaps, because that helps with that kind of environment.
yeah. Um, one more quick story, and then we'll get to Disney. I know it's what we're supposed to be talking about. So I did a diagonal yesterday. For those who don't know what a diagonal is, it is selling 1 month, buying another month, different strikes. So I did a call diagonal, and I
Mhm.
did it prior to Paul speaking. I did an upside play, so it was a bit bullish. Um, it made it to the strike. I did all the computations. It got to the correct strike for a while, and I got lucky, I think, because it expanded in value. Just like it was supposed to. News is out. Front month, I was short the front month. That decayed or collapsed volatility wise, right? So the spread widened because I was long the next one,
Yeah.
and I put an offer out. I have a very hard rule of 50% of max profit, blah 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 blah, whatever, and I got out. Okay, luckily. That
Uh,
spread, the market just steamrolled higher right through the strikes. and that sucker collapsed. And I'm lucky. I got lucky because had I not gotten out, I would have gotten hammered. But I didn't expect that last little push or that, it was a big move. You usually get a 1, 2, 3 on Powell News, right? Direction, retracement, and then a continuation somewhere. It could be back up, back down. Who knows? I think we got big up move and bigger up move. That was it. Yeah. No retracement whatsoever.
Yeah. I mean, it was relentless yesterday. But I mean, the other thing too was there wasn't like the cost of the straddle for 0 DTE yesterday was $25. I mean, that's the rare 0 DTE straddle that actually works out. That doesn't work out very often.
Right. That's something. Okay. What about Disney? You know anything about Disney?
I know they ruined Star Wars. I know they ruined Marvel. I know that they're very expensive to take my kids to the park. And I know there's
a great company so far.
They have a mouse infestation at their park. That's all I know.
Oh my. Yeah. So all those things being true. So what does Volland say? Do you want to take a peek at Volland? And can you do Volland in Disney? Yeah, let's do it.
All right. So this is a shout out to Molly, who I guess wanted she wanted this analysis done for her, right? So Molly, see what you got.
Here's what you got. All right, tell us what we're looking at, Jason.
All right, so first thing we're looking at is Vega. Typically, so normally what customers do with options, like the big institutions, the pension funds, the insurance companies, all them, typically what they do is they buy shares, then they buy a put to hedge the downside and sell the call to pay for the put. And so if you have like a large upside move, they're basically they're giving away that profit in order to hedge the downside. What this causes for dealers is kind of like a Vega curve that at some point goes positive when the price starts reaching those calls. And normally price very rarely reaches those calls. But as we've said, the upside has been relentless, no matter what stock you have. And that's what we're seeing here in Disney Vega. These large positive strikes here are the calls that institutions have sold in response to to pay for these little itty bitty green bars down here, which are puts, right? So these were their puts, these were their calls, and now we're in the middle of their call zone. With Vega, dealers hedge that using volatility, either a menu of options or or like a swap or a VX future of some sort. So they're not hedging this with underlying, right, Lex, as former market maker?
Right.
So when they have positive Vega and implied volatility comes down, as opposed to, they are short vol, right? In their, whether it's their options or their swaps or something, they are short vol and they have to contract that. Normally, when you're negative Vega, which is, you could say the normal way dealers like to be, when implied volatility shrinks, they are shrinking their long Vega exposure, which means they're selling Vega and price goes up, right?
Yep.
Right now, they have to do the opposite. They have to buy Vega in order to shrink their short Vega position when implied volatility comes down. So if you think, is that right, Lex? Does that make sense?
That's right. So what is that? Depending on calls and puts, they got to buy. You can buy reduce Vega, that short Vega that way. And one side can be bearish, one side can be bullish, or you could be buying them both, in which case it's neutral, right? So it depends.
Yeah, you're trying to get like a delta neutral. You need to get short. You need to get longer Vega if implied volatility is coming down. You need to get shorter Vega if implied volatility is going up, right? Because then your Vega is expanding. Do you like that situation, Lex, as a market maker?
Yeah, I like it. It depends, right? So I was talking about this yesterday in Vegas at the conference, right? My answer to that question is sell expensive stuff and buy cheap stuff. And my caveat with buying cheap stuff is find something a little more expensive to sell against your cheap stuff you're buying. Because I hate being naked long anything. So if volatility, implied volatility, isn't high enough, I don't want to sell it. Okay, as a market maker, as a trader, whatever. Now you might say that's great, but what if implied isn't high enough relative to realized? There's a good argument that you have to be careful there. So I understand that part. So I generally know I'd rather be short it, but not at any price. That's the point I'm trying to make.
Right. Okay. Yeah. I mean, so right now though, Disney is in the positive Vega area. You are currently short vols. If implied volatility comes down or theta comes down, you have to, drops the value of your options. You have to buy those vols back. So you're going to end up buying in response.
Right.
Vols. So it's an odd situation. Pretty much almost all stocks are like this right now. I mean, we're pointing out Disney because Molly wants to buy Disney or sell Disney or whatever.
Okay.
And, so that's a situation where.
Let me ask a question. Sorry to interrupt. Let me ask a question. So you're showing that and Vol that dealers are short Vega. Is that right? And I don't know the term structure you have here, but maybe about 30
dealers
days
are long Vega.
Oh, the dealers are long Vega. Okay.
Yeah.
Gotcha.
Which means they're to hedge, they're short vols, right?
Yeah. Okay. Got it. All right. So what have you been following the news with Disney? So I'm just trying to think. I looked at implied volatility before we came on, and in Disney, and it's not spectacularly anywhere. It's very normal, at least for the 30-day term. And I don't like to, as a retail person, I don't like to trade much more beyond 30 days. Now, I know some people will say, well, wonderful that you can get some good 60-day stuff. I agree. That's fine. Just my personal preference. I like to be 30 days and in. I just find that things that I like to do tend to start really picking up momentum about the 30-day mark. Right. So I like that. And I like the liquidity better. So I don't know if I have an overall strategy for Disney within 30 days, but the implied volatility there isn't spectacularly high or anything. There's nothing really going on that says, hey, I need to be short this premium. Do you see that as well, Jason?
Yeah, I think I don't think short premium would necessarily be the right answer. Especially since, naturally premiums start coming down, even if it's through theta, through time. Yeah. Basically, with the way I'm seeing it with Vanna is a top would probably be here at this 95 strike. I know there's a larger strike here at 100, which it could reach. But when you're positive Vega, Vanna is very important to determine. Like as the price goes up, your Vega is also going up if your Vanna is positive. So that's kind of a situation for the dealer. They're going to keep shorting, or they're going to keep buying their vol as the Vega. They're going to want to buy. They're getting longer Vega as the price goes up, but then their Vega is going up, so they have to sell vol into their higher Vega. So it's kind of it's not a situation they want to be in. Positive Vanna and positive Vega, they kind of counteract each other. So I think from a dealer perspective, 95 is probably a peak. That's when Vanna would be around 0 or balanced. But chances are, the market overall is kind of extended. I think that there's kind of more on the short side of Disney is where you'd want to be. 30 days out. But yeah.
Right. That's what I was going to say too. While you're talking, I'm poking around through TradeHawk looking at different spreads. And the problem is that if folks, listen, if you want to be short Disney with options, okay, the obvious simple answer is buy puts. Okay. Someone could make an argument with me that that's a good idea because implied volatility is very cheap. I get that. I'd rather do a downside calendar or diagonal. It does take advantage of low implied volatility because I'm going to buy a farther out month. So I'm going to collect Vega there, long Vega out there, and I'm going to sell something closer in. And I might even make it a diagonal to make the price even cheaper, right? So I'll buy a lower strike put in the back month and sell a higher strike put in the front. Now the premiums aren't very high. It's in the front month, so you're not going to get a ton. I think where you're trying to make this play is don't hurt yourself too much holding this position, a diagonal, which you won't. And if you're truly bearish, the bearishness is going to make that spread expand as well. Slight bearishness. You got to kind of get to the spot. And I would probably use an expected move over the next 30 days to compute that and get a feel for where you should place that short strike roughly. And I like to say when you're placing short strikes relative to expected value, my favorite phrase is it's like dropping grenades. Just get close. You don't have to make it rocket science or brain surgery. Get in the neighborhood, drop the grenade. You'll be just fine, right?
Yeah, I think it also depends on how you're playing the diagonal. If your short strike is closer to the money than your long strike, which is, I think, what you're talking about. Typically, delta neutral is even closer to the money than your short strike.
Yes.
So what I would do is if you have a target downside, if I were playing Disney, my target downside maybe would be like in the 90, 85 area, right?
Oh, that low.
I'm thinking like 90 is probably like a decent target, which means you would sell the 85s because delta neutral, you make a little bit of money. At 90, that's around where, your bearishness is.
Yeah.
That's where you kind of want to maximize that P&L curve.
Yeah. So I'm looking at right now, I'm looking at the premium's so low. I'm looking at December, 8 days away, selling the 90 put, and then going out into January, I think I was, January 5th, which is 22 days away, by the 89 put. So I got the 89, 90 put diagonal. That's what I'm looking at. Okay. Now it's 20, let's call it 25 cents to pay for that. Not bad. Not the end of the world. That's a cheap play for the time period, right? And here's what I like to do.
That's only $1 of difference there on your diagonal.
Yeah, isn't that fun?
I was thinking more along. I'll have to.
Well, let's do two. I think that's even better. So maybe I'll do $2. I like to keep my diagonals tight. I'm just like a one strikers general, but I moved it down once. I went to the 88. So now it's a 14.
What strikes are you using?
I'm using the 88 in the far month. January 5th versus December 22nd. And here's the reason I chose this two separate strikes is that if I don't get the move, I'm going to roll that short into the next, expiration and then collect it again and try for the move. And if I don't get it a second time, I might turn it into a put spread or something, in the serial month that I have my long in, and then I've got to roll the whole thing out. And I probably won't, if I don't get the move in the time frame, I'm not going to lose a lot of money on this. It's very cheap to pay for. So, the hope is with these kind of spreads is you've done some analysis, you're bearish, and the stock's going to actually do what you think it's going to do, in which case that spread expands, right?
Yeah.
So it's just with volatility this low, there's not a lot of choices, and I'm just not going to buy, a big premium kind of spread in Disney. I'm going to do, maybe I'll do a put debit spread. What do you think about that in the same month? Give yourself a little time.
That one, for such a close time frame, I like the put debit spread a lot better.
Yep.
One thing that I kind of say to super beginning option traders who say, I only know how to buy and sell, I only know how to buy calls and buy puts. At least make it a spread, because with a spread, you gain gamma and it lowers the amount of money that you have to pay. And you get your returns quicker if you're correct.
Yeah. No, I like that. I'm looking now. I'm back in January 5th. I wish I could share, but I'm on this little laptop and it's kind of stinks because I'm on one screen, so I can't be looking at your pretty face and looking at Trade Hawk too.
Yeah.
Yeah, I mean something like how far are the strikes on one of the put spreads? Like I'm looking at 92.89. That's only 3. That's not that great, right? We want a little more.
Yeah. So I mean, typically with diagonals, unless I'm doing it like 1-2 or 1-3 or something like that, I kind of like I target the short strike as like my thesis. If we're doing this for 2 weeks and we're doing like kind of a swing, and then if it doesn't play out, you can turn it into a spread or a butterfly or something like that. The long strike in the back. But because of that, I was looking at the 29 December quarterlies as my short strike and the 19 Jan as my long strike. I don't know. Somebody, once got me into, when I'm doing diagonals or calendars, make sure my anchor, my long strike is on a monthly because it has more liquidity. It has less to do nowadays than it used to, because back, 11 years ago, you didn't have as much liquidity in the weeklies. But
gotcha. So am I sharing my screen?
Let's see. I'm sorry. I was looking at.
I think I'm sharing my screen. Am I?
Yes, you are. You're sharing your screen. Yeah.
Okay, good. So now let's see if we can take a look at the trade hawker here. So I just expanded it to big side. Here's what I'm trying to do. I had this changed a little bit. I want to see both months next to each other. Let's do this. Look how narrow my option grids are. Isn't that nuts? So because all I use is the bid and the ask, and my spread comp, so I can move them around, and that's it. I mean, what can I tell you? Isn't that fun? The fun.
That's a high tech right there, man.
That's high tech. Okay, so this is all I got.
I'm gonna endorse Trade Hawk for a little bit, but if you're an option trader, Trade Hawk makes things so much easier.
Yeah, it does. It does. I love seeing where this stuff hits. So all I did is I'm in 2 months. I'm trying to get this so I can see everything, but I'm goofing around. I got this little laptop thing's driving me nuts, so I got to change it. Hold on. Let me do my Infinium layout. Look at that. Now we're getting some business. Okay. So here's what I was talking about at first. Okay, real quick. I know we're running late here. We got to go. I'm gonna clear this one out because I did something different. So my first blush was, you said, maybe in the 90 range. You're not getting much premium for this put right here, this 90 put. Yeah. Okay, so if I went to sell that, and then you like buying a couple down, is that right? So I could go to 87, maybe 3 points out in January to buy that put. This is a diagonal. You can just see it's diagonal just visually. That's why we call it a diagonal. I'm short the 90, long the 87 put in a farther time. And you can see implied volatilities. Here's the historical implied underneath for 30-day, 20.64. And here's where it's trading, 20.83. It's almost on top of, kind of historical of what we've seen for a while. Okay. So, and I know it's cheap because I did a little bit further analysis. This one looks cheaper, but that's spanning a weekend. So you got this spread on for, you can do it for 6 cents. Okay. 6 cents. I think I've bought candy bars that are more expensive than 6 cents. So that's pretty cheap to do that. And what we want to have happen here, if I send this to what if, I don't know, I'm on the hotel Wi-Fi, so this could take forever. Who knows? So if you send the spread to what if, you're going to be able to see that it benefits from that downside, play. So see this? Here we are. Perfect. Look at this graph. This is great. So if you're bearish in this and volatility is cheap, this isn't a horrible play. Notice we're up here now. Last trade. We're thoughtful that we're looking at this kind of price action in the underlying heading down. So this is your peak right here, right at that short strike in the front month. That's the max profit. And you can see we can certainly lose on this to a massive down move, right? So that's just the difference between these strikes, less whatever you have in it, or added to whatever you have in it. Does that all make sense? I think. I hope.
Yeah. Yeah. Okay. Mm-hmm.
Cool.
Yeah, it's as if you lost it. Yeah, the max loss is as if you lost on a vertical, on a short game.
That's right. Vertical. That's right. Mm-hmm. So anyway, there's lots of things to do. I think. Just the general takeaway, though, with the Disney for Molly is that I'm bearish on the stock for now. I think they've got to clean up their streaming. I think they've got to clean up their message, right? This is a family company. Families love this company, or they loved it. and they're doing dumb things, in my opinion, okay, relative to that. So if they bring back the magic there, they might bring back the money and get themselves out of this little conundrum. So, I think until Iger can figure that out, and they have a streaming problem too, right?
Yeah.
So there's some headwinds for them for sure. He's probably the guy to do it. I don't know. He's done it before. We'll see. I'm sure he got a good paycheck.
It's hard to, when you think about it. If I'll tell you this, when I retire, I am done. Like, I mean, if somebody tries to bring me back, the whole retirement thing, like he was out there playing golf, and did he get bored, or did they drag him back to like, please save us, or did he just like
a couple things that could. Yeah, there's a couple things that could drag you back. Generational kind of money, probably.
Yeah, I mean,
right. Not that he needed it.
Yeah, Disney, right. I think, is flooding the market with content, and I mean, like flooding. I mean, it seems like there's a new Marvel movie every month,
right.
And then or Star Wars movie or another show, like the Mandalorian. I watched like a couple episodes, but got bored. It was the Mandalorian.
Oh,
but but I mean, it's so there is a lot of content, but they have like a lot of history too. So I think if you're playing like the 5-10 year range, you might like Disney, but I don't know. The parks have gotten really expensive, like really, really expensive.
Yep.
I know parents leaving. I went to Disney Park right out of COVID, like it was like 2002, I think it was.
Yeah.
Or 2001 or 2020, 2022 was last year. No, I guess it was the year before, 2022. And there's people walking around. Everybody wears matching shirts in Disney, right?
Yeah.
Including us. But there are people walking around saying like, I went to Disney and now I'm broke. And that was before all the price raises. And like that's what their matching shirts are. It's like, I'm broke here in Disney, and I'm like,
that's awesome.
I can't imagine, what it is like now. So
yeah, no, I'm with you. All right, we got to go. Right. Good talk. You have a good rest of the weekend, Jason. By the way, I plugged the heck out of Volland in Vegas.
Excellent. Thank you. Appreciate it.
Yeah, I even I didn't ask you to do this. I hope I'm not going to get sued. I even put it up on the screen and showed him a little graphic of it. And I told him it's Volland and go to vol.land, and so it was a big plug, man. I was pumping it.
Where do I send the cease and desist and the lawsuit?
That's right. Send it to Max.
Okay, Max, I got it. Max.
Yeah.
Max, check your inbox.
Yeah, no, I'm pushing you, baby. So
I appreciate it. Thank you.
All right, you guys have a great weekend. We'll talk next week, okay?
You too. I'll say it from Mark.
All right, man.
Happy trading.
Happy trading. That's a banger.